David, you said investing, and it's long-term investing. And if 2022 has taught anything, is that you can get scared out of your longs. So hedging for beginners is what I chose as my topic. And hopefully this lets you go through this sideways chop or whatever difficult market we have going forward. So let's go ahead and start. Let me just go ahead and do this way. So disclaimer, trading is risky. All the trade setups and whatever I have on my blog or private Twitter is only for educational purposes and not intended for any financial advice. Risk the only capital that you are willing to lose. That's how we trade. Let's go ahead and talk about me. I've been trading for more than 8 years. I am currently a contributor at Laduk Trading. I run options Discord channel at Laduk Capital. I also have a one-on-one options mentoring sessions and my own Twitter Trade Alert subscription. I write 2 Substack newsletters. One is daily index income option trades. So over here, what I do is every day pre-market, I look at the 3 indices, ES, NQ, and RTY. I don't usually trade Dow, so not the YM, but I look at those and do fib analysis, do the options measured move that is expected, and come up with every day an income trade on either the SPX or the QQQ. I usually go with SPX mainly because of the fact that SPX has all weekdays as expiration. So, you could sell something and not have to hold overnight. So no overnight risk. So you can check me out there. So before I start this hedging, I'm making some assumptions that you have a long portfolio and you are willing to do some active management. There's no buy and hold anymore. You can see even, companies like Roblox can fall 70 to 90%. So even Roku. So you would have to do a little bit of active management. If you are willing to do that, then hedging for beginners, this should give you a lot of information. Plus, I'm assuming that you at least know a little bit of options where I'm talking about long call, what is a short call, long put, and short put. So from those assumptions, let's start. So what is hedging? Hedging is a strategy that limits your losses in your long portfolio. When hedging is done properly, we are limiting the downside or offsetting the losses in our long stock. So you can consider hedging as a home insurance. So you pay for your home insurance monthly, or you pay a lump sum 1 year, premium, but that takes care of you not losing your home. If there is a fire or anything, you are covered. So you can consider hedging as a home insurance, except in stock hedging, you don't have to pay a fixed amount each month. It varies. Why it varies? Because you are not taking a 1 year thing. You are paying monthly if you are going to do monthly options. But we have a flexibility of putting it on or off, right? I don't need to hedge every month. I don't need to hedge every week, but I need to have home insurance all the time. For stock hedging, you don't need to do it. You just need to do when you think it is necessary. Now, when you think it's necessary is subjective. So let's go into that. But so in terms of home insurance, why do we keep it all the time? Because you don't know when a storm is going to come. And if you know that a storm is coming, at that time, the insurance is going to be very expensive. So similarly, if you wait too long to hedge and the market is falling, then the volatility spikes up and all the put protection or the hedges become very expensive too. So you are supposed to do it before the storm comes, but you're not expecting the storm every time, so you don't hedge every time. Okay. Now, why hedge? If 2022 has taught us that stocks can go down, even the ones that we all love can go 30 to 50% down. So being proactive and hedging in early part of 2022 would have helped and saved many portfolios. Another reason for hedging is that if you did not hedge, experiencing huge drawdowns makes you feel vulnerable, and you can get out of your longs that you actually wanted to hold for 5 to 10 years. Okay, you can get scared and get out of it. So hedging is actually beneficial because it helps you sleep at night. Now, there are different types of hedging everybody talks about, especially everybody says, oh, I have a diversified portfolio. If you have a diversified portfolio, not everything falls at the same time. So that's one way of hedging, but you will see that this year that did not work as much. Another way of hedging is using options, which are derivative products. Okay. Then you can go long volatility, right? When market is falling, VIX goes higher. So you can go long volatility products. You can use leveraged and inverse ETFs. We'll talk about them. You can use futures to hedge your long portfolio by shorting the future, ES futures. You are hedging your long portfolio. And the easiest and the best is to have some cash. Okay, that is another way. Now let's talk about diversification. Okay, some assets and asset class move the opposite of the general market. So having some exposure, right? Have some bonds exposure, have some Bitcoin, have some gold, have some commodities, and that's your diversification. Now everybody has a different formula of how much gold to have and how much bonds to have, but being truly diversified is a myth according to me. Okay, because when market crashes, almost all the correlations become one. At that time, when people are trying to raise cash, when there is margin calls going around, nobody sees who is holding what, they're just selling. So nothing holds up. Okay, so being truly diversified is really a myth according to me. And for the record, if you had seen this year drawdown, having little energies and utilities exposure and being long dollar was the only hedge that you could have. Everything else did not perform. Even bonds fell. So diversification doesn't help. Okay, that's my opinion, and that's how I look at my portfolio. So now let's look at when to hedge. Okay, like when I said home insurance, we have to have it all the time. So if you hedge all the time, that means you are having long portfolio and you buy SPY puts every week. What are you doing? You are going to be losing a lot of money, because if the market goes up, your put options expire worthless. So we have to be a little strategic and how to hedge. So, right, I'm considering insurance as an example. It is necessary. It is an expense. It is a fixed cost, right? Similarly, if you consider hedging necessary expense for your portfolio, then you need to do it. But we can be efficient so that we do not need to spend that expense every time when it is not necessary. Okay, so being selective and efficient is the more important thing. So how do you hedge a long-term long stock portfolio? So this is not something that I'm talking about in my trading account. My trading account is different. This is my long-term long stock portfolio, how I hedge. So, okay, I'm watching the NYA chart for clues. Now, NYA is the NYSE Composite Index. It is a float adjusted market capitalized weighted index. It includes all the common stocks listed on NYSE, including ADRs, including REITs, and some foreign companies. Okay. So it is kind of a big basket of everything. So whatever it does, right, I'm tracking that to figure out whether I need to hedge or no. If the weekly close on this chart is below 21-week moving average, then I am putting out my market hedges. Okay. The hedges could be just buying SPX puts or QQQ puts. Okay. So now let's go to the, what is this? Okay. So this is the part of the NYA chart that I have printed out. Okay. Here you see that things had started going down. The moving average had become flat, but it had not yet closed below the 21 EMA moving average. Okay, this is where it actually closed below the 21 EMA. The MACD had already crossed down. It was already giving me warning signs. Okay, the indicator is going down and the price was going higher. So this divergence was already there from last year onwards. Okay, this divergence of the MACD showing that something is going down, whereas the price kept going higher. That was already a warning sign from, actually, if you look at September, October of 2021. Okay, so from October 2021, this warning sign was already there. But I'm talking about, this is the warning sign tells you get, okay, tighten your stop. But this is my long portfolio. I'm talking about long-term long portfolio. So raising a little bit of cash, being sure that the amount of cash I'm being, that's what I did, but I had not had any hedge put on until this. That was February 14th, 2022. That's when it closed below. Okay. That's when I added hedges by SPX puts. Okay. Now I am still hedged. Why am I still hedged? Because the moving average is pointing downwards. The price is still below the 21 EMA. MACD has not yet crossed over. So I have no signs that the market is still safe for my long portfolio, not my trading portfolio here. I'm talking about long. That's why I'm doing this. Okay. Now let's look at how do I decide how much to hedge. Okay. Which ETF to use. You can hedge by buying an SPY put. You can buy by buying QQQ put, IWM put. You can buy so many things, right? So which one do you use? Okay. Now, first of all, step is I'm waiting for that chart on the weekly to close below 21 yen. Then I am actually beta weighting my portfolio. Okay. If you have, okay, a lot of financials, then there's no point hedging with QQQ put because there are no financials in the NASDAQ, right? So knowing the holdings is one thing, but knowing how much to hedge and which ETF to use, this beta weighting helps. Okay, beta weighting tells me which put I would be using. Now, what is beta weighting? Okay, a $1 move in Tesla is not the same as $1 move in Apple, and it's not the same as $1 move in Walmart. Why? Because they have different prices, different volatilities, right? The average true range, the daily range that a Tesla can have is not similar to what a Walmart has. So the similar move are not same. The same amount of movement is not the same. So we do beta weighting to an index. It's more like we are normalizing the position, or we are trying to make the denominator same so that we can analyze the same what is the Tesla move compared to Apple, right? If one day Apple goes up $5, that is a huge move in Apple, right? Whereas for Tesla, that $5 happens probably in seconds. So knowing those volatilities and knowing how much of Tesla you have compared to how much Apple you have. So how do you, if I buy just one SPY put, but you have 100 shares of Tesla, 100 shares of Apple, right, in your portfolio, and say you have 100 shares of Walmart, the effect of Tesla on your portfolio is bigger than the effect of Walmart on your portfolio, right? So when Tesla goes up, it goes up huge. So you have a huge return. That's what everybody experienced in 2020, right? But the same thing happens if Tesla goes down, it moves huge. So it's going to have a bigger impact on your portfolio. So how do you measure that? And so how, if you are able to measure that in some form, then you know how much to hedge. So that's what I'm talking about. By beta weighting to an index, we normalize each position risk across the whole portfolio. Beta weighting makes it possible to make the comparisons. So we are able to compare Tesla with Walmart, okay? So now let's still think about what is beta weighting, okay? It's important to know your exposure based on that. So beta weighting helps us to equate our different stock positions, compare risk among our different stocks, since the base or the denominator becomes the index, okay? It puts all positions on a level playing field, allows me to look at my portfolio risk from one product perspective, okay? We usually beta weight to the SPY, okay? I just took a random few for stocks, okay? Random quantities. And so I'm showing here, okay? I have 125 deltas, means 125 stocks, okay, or shares. For Illumina, I have 25, okay? I just did randomly. So this is no beta weighting, tells you that I have 249 delta, which means I have 249 shares. When I beta weight to SPY, okay, my deltas change and my total delta becomes 23.3, okay? So if I have 249 shares, I don't need to hedge 249 shares, because if I compare that to SPY, it shows up as 23.3. So if I am able to do an inverse of SPY equivalent to only 23 shares, I'm good to go, okay? If I beta weight to QQQ, it becomes 2797. So this itself says that my portfolio, however small, is getting more affected by QQQ than by SPY, okay? So this was just a way to show what is beta weighting. Okay. So that's what I talked about, okay? It's like owning 249 shares in my deltas, but beta weighting to SPY, okay, we finished this. What does this mean? If SPY moves down by $1, then 100 shares of SPY, if you have, you are down by $100. Right? But this portfolio will be down only $23.3. This is just a simplistic representation, okay? This is not the exact thing. No calculations, no math or any of that. Just a simple way of you to understand that the deltas, when you beta weight, you come to know how much. So if Tesla is having, say, 2.08 beta weight compared to SPY. I don't know what the current beta weighting of Tesla is. I'm just making an assumption. So if it is 2, so it means that if SPY goes up 1%, Tesla probably is going up 2%. And it works not only the upside, it works the downside. If SPY goes down 1, Tesla is probably going down 2% because its beta is 2. Okay. So you have to, if you have Tesla in your portfolio, you have to do more hedging just to get normalized. Okay, that's why I just did this. So it's just a simplistic representation, but I'm just giving you an idea. Okay, now with this portfolio that I just built, okay, I don't need to hedge a lot, right? If SPY is going down by 1%, I'm not even going down by 25.25, right? So I don't need to hedge with this portfolio that I have. But let's think about this. Okay, suppose you own 100 shares of Tesla and 100 shares of McDonald's in your portfolio. Tesla has a beta of 1.48, while McDonald's has a rating of 0.55. So you can simplistically think about, okay, it is as though you own 148 shares of SPY because you have Tesla, right, with the beta rating of 148, and you own 55 shares of SPY due to the McDonald's that you have. So a total of 203 shares. Okay, so instead of just buying a Tesla put to protect Tesla, buying McDonald's put to protect McDonald's, by beta weighting, I normalized it. I can think in terms of how much SPY shares I have, and now hedging becomes easier. If I have 203 shares of SPY, that means I can just take 2 put options for SPY and hedge it, okay? So, right, I can buy 2 contracts of SPY at the money puts to be theoretically fully hedged. So my portfolio goes down 1%, but my SPY puts, because I've bought 2, right? I have 203 shares, so I'm buying 2 puts at the money. It will fully kind of hedge. That means it offsets my losses, okay, in my long. I could also buy 1 at the money Tesla put and choose not to hedge McDonald's at all, right? McDonald's usually, when you think about it, okay, McDonald's is more safety play. When SPY goes down, it and 1%, McDonald's goes down by 0.5. So plus safety, there are people who have to be long, institutions who have to be long, they will go into safety. So there are chances that McDonald's goes up. So I can choose just to buy a Tesla put and not hedge McDonald's at all. So there are many, many ways to hedge, but knowing when to hedge, how much to hedge is the most important part, which I shared to you today. Now let's see at what all instruments can be used to hedge. Okay, we have inverse ETFs. Inverse ETFs like SDS and SQQ work opposite the market. So when SPY goes up, SDS goes down and vice versa. So why are these things available to us? Okay, not everybody does options and not every account is enabled for options, right? You can hedge your portfolio in 401k. There are some restricted accounts where you have to be long only. That means you can only buy, you cannot short anything. Okay, so you cannot buy puts, you cannot short SPY shares. So there are instruments available that synthetically do that for you. So SDS and SQQ are inverse ETFs. They go opposite the market. Okay, so you can use that as an alternative to derivatives. The drawback for these kind of inverse ETFs is that it has complicated rebalancing. It has to rebalance every day. Okay, at end of day, whatever is the SPY, whatever the move was, based on that, it has to rebalance to be able to do what it does. Because it has so much of work to manage that kind of rebalancing and has to be there. They are using synthetic products or derivatives in turn to be able to accomplish this kind of market behavior, right? Trying to do the opposite of what market is doing. So they are using synthetic products in itself to have this product available to you. There are higher expense ratios and there is a volatility drag. I don't want to get into volatility drag. It's more like, right, they have to buy or sell futures. They have to, so futures contract, right, as volatility changes, they have to do more or less. So there is always, for a long-term basis, nobody recommends use inverse ETFs or leveraged ETFs. These are for short-term uses only. And I'm talking about hedging, which is going to be short-term for you. Okay. What are the different types of inverse ETFs? Okay. There's a whole bunch. You can do SQQQ, which shorts the NASDAQ. You can do SPXU, which can short the S&P 500. You can do DDG, which is short the oil and gas. Okay, you can do the Dow, right? So there are so many ones. The ones that most of us use, right, is SQQ, SPXU. Then you have, right, TZA, which is talking about, that's the leverage, we'll get to that. But you can short the China, you can short the bonds, you can do short the financials, right? There are so many inverse ETFs. Okay. Then there's list. Another way of hedging is also known as leveraged ETF. A leveraged ETF is an ETF that uses financial derivatives and debt as leverage to amplify the returns of the underlying index, such as SP 500. A leveraged ETF attempts to double or triple the daily returns of the index. Okay. So if you are going to use, okay, 2x, okay, bear of SPX. What does this mean? If SPX goes up 1%, right? This is bear. Okay. If it goes up 1%, this bear does the opposite, but it does twice, right? So it goes down 2%, right? So if it goes up $1, this goes down to $2. If this goes down $1, this goes up $2 because it is double. So to try and get to that, okay, they are using financial derivatives, debt. They're using a lot of leverage. Again, okay, so these are again alternatives to derivatives. You don't need to use options all the time to be able to hedge. So you can use these leveraged ETFs, and these leveraged ETFs, not the pros are you don't need to use options. Plus, you can see it provides outsized return. Now you can think of it in two ways when you are actually hedging with leveraged ETFs. Okay. In the previous example, we said after beta weighting, I have 203 shares, right? Equivalent of SPY. So rather than buying two puts, right? Rather than buying two puts of SPY, if I took the 2x bear, right? I just need to buy 100 shares. I'm not going to options right now. I'm just doing leverage ETF. Okay. So if I took the 2x bear of SPY, I just need to buy 100 shares to fully hedge myself. Okay. And then it can give me double the return. I have to buy half of it, first of all. Plus, when volatility goes higher, right, they are using leverage and they attempt to double or triple, which means they try to always keep it 2 times or 3 times, but it usually exceeds. So there is a chance of you getting outsized return. Again, same like inverse ETFs, the drawbacks are, right, every day complex rebalancing, higher expense ratios, and volatility drive. To know a lot of leveraged ETFs is really beneficial. Okay. SPXS is the 3x there. Okay. So you're trying to triple. So I would not even need to buy 100 shares. I need to do probably less than that. TZA is small cap bear. SOXS is semiconductor bear. Okay, so you have a financials bear, biotech bear, TECS is the technology bear. So if you have a lot of technology companies, right, you had all the cloud names and everything in your portfolio in 2022, rather than doing an SPX put or an XLK put, which is the technology ETF, you could just do a TCS, right? Because it is 3 times. So you have to buy less, but it provides more. Of course, you have to be very selective with this, okay? Then if you had all the FANG stocks, right, you have FNGD. So you just need to, all your FANG stocks are taken care of by here. You don't need to have the entire QQQ, which has other biotech stuff too. Then you have gold miners, you have energy, right? There is another, this one, HEDGE, I've tried to use it. It doesn't, it's not that liquid, but I'm just mentioning, you just need, it's all high beta stocks. So things that move more than the SPY. So the high beta stocks, there is there. You have cloud computing. So you have, I'm telling you, on now recently they came out with Tesla inverse, Nike inverse, NVIDIA inverse, okay? So you can use the Nike, NE, Nike Q. It is double bear, 2 times leverage, okay? So you have even single stock leveraged ETFs now that you can use to hedge and manage your portfolio. Now let's think about all these is just buying, right? When you're doing a bear, you're just buying, so it's again buying. Now let's use derivatives or options to hedge. Buying puts in the underlying or SPY or QQQ is another way to hedge your longs. We have options on inverse ETFs and leveraged ETFs. So you can actually use options on those inverse and leveraged ETFs to actually use very little. Okay, so if I did the SQQQ, or right, SQQQ, if I have a lot of tech stocks and I use SQQQ, I buy shares. It's just 1x, right? QQQ goes down, SQQQ goes up. Now let me buy calls on SQQQ. Okay, so I am using leverage on my hedge that can amplify my hedging, and I don't need to buy hundreds and hundreds of shares. I just need to buy a couple of call contracts and my entire portfolio is hedged. Okay, another way is when you are hedging by buying the stock or the inverse ETF that we talked, you are actually hedging. But when you are buying, you're using leverage on, by using options on inverse and leveraged ETFs, you are actually using your directional bias also, right? You can make a return. You don't necessarily, if you have hedged right, there are times when your hedge outperforms so much that you are profitable, right? It's not only offsetting your long portfolio, you are becoming profitable because your puts outperformed, right? So using beta weighting to determine how much to hedge is a different exercise. Buying puts as a directional trade is a different thing in itself, okay? But once you know what to do, you can do both. Now let's think about long short as a hedge, okay? There are many long short funds, okay? So this is one that we all have access to, okay? If you thought all these inverse ETFs, buying puts, looking at a chart is too much, right? And I can't do this, even though I said yes to active management and I thought I can do this, but now I don't want to. So you can just choose long short as a hedge, okay? There is an instrument called BTAL, okay, which is the US market neutral anti beta fund. It's an actively managed fund that take long positions in only low beta US stocks, and it offsets by shorting the high beta stocks. Okay, so it is shorting the Teslas and the Amazons and all the Roblox of things and buying the Walmarts and the Targets. Target having 25% down on, that is not low beta, but you get the point. Right, having McDonald's and Walmart and all some utilities, those low beta. So this is another way to hedge. The only drawback is it has a huge expense ratio of 2.53. Okay, so this is high expense ratio, but this fund should theoretically bring down the volatility in your portfolio. So if you want to hold on to all your Teslas, and I'm like, one day, 2 months ago, it was 1,500, now it's at 700. You can't take that much volatility in your portfolio. Having a small bit of this can try to neutralize it. Okay, so this is one way of thinking about that. Okay, now let's think about different option strategies for hedging. Okay, so I'm giving you everything. I'm telling you what to hedge with, when to hedge with, what signs I look for when to hedge. You can hedge with ETFs. You can hedge with inverse ETFs. You can buy puts with them. How much to hedge, all that we did. Now, I'm going to talk about option strategies that can be used for hedging. You can buy puts is the obvious way to hedge your long. As we discussed, hedging is expensive and it eats from your ROI. If the market does not fall, your hedges go waste. Okay, so there are different ways of hedging, right? Now we talked about you having a portfolio, right, with Tesla, McDonald's, right? Now I can just buy a Tesla put, not buy anything on this. That is my hedge. That's one way of doing it. Beta weight both and buy SPY puts. Beta weight both, buy SPXS, right? The bear, which is the 2X, and then buy less of it. That's another way of doing it. But all this, right? If I have 10 positions, am I buying 10 different puts? No, right? That would be too messy. Then because of that, we have sector ETFs, right? You have sector ETFs. If you have all the technology companies, you can just buy a put on XLK, not go with SPY. There are so many ways to hedge, but all this is expensive. You're still buying a put. What if the market doesn't fall or crash the way you were anticipating? Then you have wasted the money if you think it that way. So why not find a way to fund your hedge, right? I am the stock I bought. Again, that is buying. The hedge I am buying. So nobody has infinite amount of money. So why not fund my hedge in some way? And options lets us do that. So now I am assuming that you guys have some options basic knowledge. Okay. Ultimately, there are only 4 things that you can do with options. You can buy a call, sell a call, buy a put, sell a put. Now, all option strategies are a combination of all these 4. Okay. When you buy a call, you give the buyer the right to buy a stock at a strike price before a specific date. Buying a put gives the buyer the right to sell the stock at the strike price before a specific date. When you sell a call, right, you become the seller, right? The seller has the obligation to sell the stock at the strike price. Selling a put means the seller has the obligation to buy the stock at the strike price. Okay, so I am talking about doing a collar strategy, or which is also known as a hedge wrapper, okay, to protect your stock. Now I've gone from hedging the entire market with SPY or inverse ETFs to hedging for specific stocks. Now, why would you need to protect against specific stocks when I can just beta weight and just keep buying SPY and QQQ puts, right? But you have earnings at least 4 times a year, right? When you are going to get some news, all the financials from the companies, and from last 6 months, we've seen that Netflix can fall 25%, right? Target can fall 25% just on earnings. So protecting, having an SPY put when Target falls 25% doesn't make sense. It is not an actual hedge. You're hedging against for the market fall, but here only one stock falls. So during earnings, you're looking at hedging for single stocks. And we are talking about stocks that you own. Okay, so if you have 100 shares of Tesla, right, and you were worried, like Tesla had its earnings just last night, okay, if you had 100 shares of Tesla and your buying price, okay, your cost base is say $350, okay, this is my assumption. Now it's at 750. You were panicking with what happens to this Twitter deal and everything. What if it falls, right? And you wanted to protect your Tesla shares or the gains in Tesla. You can sell, right? You can sell, say, 1,000 strike price call. Whatever money you get by selling that call, that money you take and buy a put, okay? At that time, you are buying a put. Now, when you are selling $1,000 call in Tesla, what are you saying? When you sell a call, you are obligated to sell Tesla if it closes above 1,000, okay? There are ways that if it, suppose Tesla had gapped up and gone to 1,200, okay? You could just roll this in time and still get out of the trade slowly, okay? But you are trying to, you bought at 350 and somebody is willing to pay you to get out at 1,000, why would you not take that, okay? At least that's how I think, okay? I'm getting almost $650 per share profit, and if somebody is willing to pay me $5 for it, why not, right? So for one contract, right, I have 100 shares. For one contract, I made $500 more. So I'm not only selling it at such a huge profit, I am getting something for it. Now I use that $500 to buy a put, okay, on Tesla, and that's how I protect myself. So this is called a collar strategy or a hedge wrapper. What you are doing, you already have a long stock. Then you sell out of the money. Out of the money means where the stock is not currently in. Everything above the current price, that is called out of the money. And you're buying out of the money put. It means where the stock is not gone to the downside, okay? You can configure it for a credit or a debit, okay? So I will give you an example of that, how to do it. Okay, so let's go through an example of AMD. So here, what is a collar or a hedge wrapper? The stock payoff is simple, right? Over this, don't think that this is anything complicated. This is the stock's return, right? As it goes up, you are making money. As it goes down, you're losing money. Okay, now a collar position, what does it do? It makes it, okay, you're capping your profit because you sold it over here. Now, if the stock goes to 1,200, you still are profitable only till 1,000. Okay, so that's where you limited your upside risk, and then you bought a put, so that starts increasing once it goes down. Okay, so you limited your downside. Now this downside does not occur anymore. Okay, so that is what you're getting. You short call, you got the credit upfront. Any price below the strike price, you keep the entire credit. Okay, if Tesla doesn't go to 2000, you are keeping the entire $500 that you made. Long put payoff is if stock goes below the strike price. So whatever put you bought, it has to go below that for you to make money. But at least you are protected. And that is what we are talking about. We are talking about protection. Hedging is just protection. You are not intending to make money on it. You are just trying to protect your long. So let's think about how to do an AMD collar trade. Okay, you are long AMD from $76. Okay, currently it is trading at around $86. That's when I made this thing. I made this last month. Okay, so how do I select out of the money call to sell? I use deltas. Okay, deltas is more like thinking about what is the probability of stock reaching that price before the expiration. Okay, simple way of thinking. So I use deltas, expected move. Okay, how much for the earnings it is supposed to move. You get that in Thinkorswim. Okay, and then decide what strike to sell. Okay, based on the chart, I'm like, okay, it can go to 100. Right, that can provide resistance. So I could sell a 97.5 call. Okay, I did this last month. That's why it is June 17th expiration. Okay, for $4.10 credit. So I am getting almost $410 credit to sell at 97.5. What did I say? My cost price is 76, and I'm almost selling at $100. I would take that profit every day. Okay, so I'm fine. I'm fine to sell 97.5 call for $4.10 credit. Now I am going to take that $400 and buy a put. How do I select which out of the money put to buy? In this case, I could sell the 72.5 put for 2.6 debit, or a 75 put for 3.15 debit. So I got 410 credit. I can say, okay, I'm willing to take $4 loss, okay, in my stock if something happens to AMD in earnings. So at 72.5, but if it goes below 72.5, I am going to be protected. For that, I'm going to pay only $2.60, right? Which means I am paying 260, but I got 410 credit. So I'm still making money here, okay? I am making money on the stock and protecting myself, okay? If I wanted to be very conservative, I could still go ahead and do it with 75 put, which is $3.15 debit. I would still be making money, still be holding my stock, and still protecting myself, okay? Now, that was the AMD collar trade that I talked about. That can be done. Now, there are many other ways to do it, okay? There is something called as 3-in-1 collar trade that I do sometimes, right? You may think that you have only one, right? Now, this is not for earnings. When you're trying to do a 3-in-1 kind of a collar trade, you are not going to be doing it for earnings. You are doing it for a sector crash or a market crash kind of a thing, right? In April, May, everything was falling, right? So if you have 100 shares of AMD, 100 shares of Qualcomm, and 100 shares of Marvell in your portfolio, okay, I'm just talking about portfolios, right? So if you have so many semiconductors, so then based on the collar trade that we just learned, what are you talking about? I have to sell an AMD put, okay? Sell an AMD call, buy an AMD put. Sell a Qualcomm call, buy a Qualcomm put. Sell a Marvell call, buy a Marvell put, right? Why should I do all this when we just learned that we have leveraged ETFs, right? They are from the same sector. Market is, when all semis were not performing, it did not matter whether AMD is a better company than NVIDIA or NVIDIA is a better has better finances than AMD. At that time, the entire sectors were falling, right? So when entire sectors were falling, why not use the sector ETF to hedge, right? But I'm combining the collar concept and using the hedging concept together, okay? You need to sell out, right? We talked about this. What I did, okay, this is what I did for myself in May, actually, okay? So I decided to sell the 25 to 30 delta calls in AMD, Qualcomm, and Marvel. That part did not change. Selling call part did not change. I own the stock that is already there. I am selling the call in those three AMD, Qualcomm, and Marvel. That part did not change. Instead of buying individual puts in AMD, Qualcomm, and Marvel, I chose to buy one XOXL. Okay, XOXL is a 3x leveraged semiconductor industry ETF. Okay, so it does opposite, right, of what this does. So in this market, right, when everything is falling, correlation becomes nearly 1. So instead of buying one put of AMD, one put of Qualcomm, and one put of Marvel, I chose to buy just one put of XOXL. I was protecting AMD, Qualcomm, and Marvel together and funding it by selling 3 different calls. So I was making more money and still being protected. Okay, so that is how I had protected myself and my portfolio. So let's go ahead and recap. Okay, hedging is important and necessary for someone that is willing to do some active management of a portfolio. Hedging is expensive, so you need to do it efficiently. Beta weighting the portfolio to know exactly how much hedging is required. Okay, you can use inverse ETFs, leveraged ETFs, and options are different ways to hedge. Always cash is the best, right? There are ways to fund your hedging, like the trade that I went through. Like I said, I do write a Substack. Okay, you can subscribe to that. I do options mentoring and I have trade alert subscription products. So you can use the promo code women's20 to get 20% off. That's all. I'm done. If you have any questions, you can let me know. I have a couple of minutes, I think, and I can answer. David, I'm done. Anybody has any questions? I can